Good afternoon and welcome to our Tax Strategies webinar. We're happy that you could join us from the comfort of your office or home without having to go out into the cold and snow. My name is Sean McDermott and I'm a certified financial planner and president of Summit Investment Advisors, and I will be hosting the presentation today. Before I start into the webinar, I'd like to take a minute to talk about some of the features and give you a basic outline of what we will be discussing. For those of you who are viewing the conference through Join Me Online, please let us know by logging into the green icon. You'll see the green icon with a person, so click on that and then go down and click on person number 1. And then from there, you can type in your first and last name. After that's done, you're now registered into the conference. And if you have any questions as I'm going through the material, I'll plan on answering them after the webinar. And you can just click on the chat bubble and type in your question. And then if the question is a little bit more personal in nature regarding your situation, go ahead and just type in your name and your phone number in there, and my office will give you a call. The workshop slides are going to be available for you today. So if this is the first time we've used Join Me conference services, so hopefully we don't have any hiccups during the presentation. So let me tell you a little bit about who we are and what we do. Summit Investment Advisors and LPL Financial Services are independent companies that provide financial services, financial planning, investment, and estate and tax planning services. Primarily people that are at or near retirement. We have a full team of advisors that can help you with your stock and any stock calculations that I discussed today. We host many different workshops, as you'll see at our website under the Education Center. We do record quite a few of our workshops. You'll see we have health and wellness workshops. Some of our more popular ones last year were the Alzheimer's Tsunami. We had a workshop on planning for healthcare during retirement. Some other more interesting topics like energy for performance, BrainWorks, and I think we had the most attendance last year in Declutter Your Life. So if you'd like to see any of those workshops, go ahead and take a look under that tab on our website. And then for those of you that like to see this full workshop on stock strategies, we have presented this before, so you can open up that video right there and then just watch it if you'd like to see a repeat of any of this. In addition to that, next week we have under our Summit Events tab, you'll see that we're hosting a Manage Your Taxes All Year Long workshop. And so this will go much more in detail into the tax planning strategies, tax brackets, and so you can come either to the noon or the 4:30 p.m. So if you're interested in registering for that workshop, please feel free to do so. With that said, let's go ahead and go into our slide presentations. We also, on our website, I should mention that we have a client center there. So if there's further questions or if you need to contact us, feel free to just open up that client center, and our phone and email, etc. is all right there. Now today in our workshop on our agenda, we're going to talk about the basic steps, which begins with calculating your stock cost basis. We'll talk about how income taxes work, and again, we'll go more in detail about that next week. We'll look at strategies on stock gains. I'm going to talk about 6 different tax strategies that you might implement in order to reduce your taxes, and then we'll go through some next steps in your planning process. We're going to start off here with looking at employee stock purchase plans, their benefits, their features, and their tax treatments. We'll also talk about direct purchase plans and dividend reinvestment. Now, most investors and corporations have in place what we call a qualified ESPP, or Employee Stock Purchase Plan, under Section 423 of the Tax Code. The non-qualified ESPPs are not very common. We don't see these around very often, and they're more like a stock option plan. The third type of stock purchase plan is an open market or direct purchase plan, and that's where you would buy shares of a company's stock at a brokerage like LPL Financial, Wells Fargo, Vanguard, where you could start buying stock and then from there purchase additional shares through dividend reinvest or just directly sending in a check. Now, many successful investors have started off their careers by enrolling into a company stock purchase plan. And when you originally sign up, or at any time, you can sign up into these plans where you can elect to have a specified amount deducted out of your paycheck, typically 2 to 10%, and it will be going into purchasing company shares of stock. It's not pre-tax like a 401k plan, so there are some tax features I'm going to talk about. And then there are some offering periods that during the enrollment periods that you can get into the purchase plan, and the company will be buying shares at specified periods of time. So many times I hear stories from investors who said somebody at their company encouraged them to sign up for the plan early on. It could have been their boss or a friend who said to start buying the stock, and now you look back and realize what good advice this was early on in your working career. So I typically recommend that you start investing 10% or more into your 401k plan and adding another 5 to 10% into employee stock purchase plans and just getting used to it being taken out of your paycheck. So for those people that might have younger employees around them, be sure to mentor your knowledge and pass on the word to start early into these plans. Now, the tax qualified employee stock purchase plan, the first thing is there's no tax at purchase and never any FICA or withholding. So what this means to you is that if you're enrolled in the plan, you're saving 7.65% on the purchase of your shares. So if you're not above the Social Security withholding threshold, you're getting a nice little discount right up front on the purchase. In addition to that, a lot of companies will match or discount their stock anything from 10 to 25% discount price on the purchase of your shares. So for many investors, you're receiving anything from a 20 to 30% return on your money before the stock even grows. Now, you don't have to pay tax on the stock until you actually sell the stock itself. And that would be treated typically as a qualifying disposition, and that's if you hold the stock for 2 years from the offering start or 1 year from the purchase. The tax treatment for a qualified disposition, assuming a rising stock market, most of the gain over the purchase price taxed at capital gains tax rates. And there could always be a small amount that's taxed as ordinary income in an employee stock purchase plan. The tax treatment of a disqualifying disposition would be ordinary income on the spread at purchase and a company tax deduction for this spread. So what this means is if you sell the stock too early on, then you'll be taxed at ordinary income tax rates, which are different than the long-term capital gain tax rates. Now, this is a fact that a lot of investors are not aware of, and that's where it says W-2 reports ordinary income and Form 3922 for the prior year's purchases. So starting in 2012, transfer agents and employers are required to send a tax reporting form 3922 out to you. And what this reports is the employer discount on the share purchased through them. So if you have a 15% discount on your share price, that portion is going to be taxed at ordinary income tax rates. So at some point down the road when you sell your shares, or in the case of Medtronic Corporation when they go through the inversion, the portion that is attributed to the discount on your stock from your employer, you need to pay tax on that discount at ordinary income tax rates, not capital gain tax rates. And if you don't do so, if you're not aware of this, you're going to be subject to a tax audit. So be sure to talk with a tax professional if you don't know how to run these calculations. Now, as I mentioned earlier, we're going to have a workshop on January 22nd that will really dig into how income taxes work, but for today's presentations, we're going to stick mainly with capital gain strategies and how to avoid capital gain tax. So the income tax workshop we'll have next week will delve more into determining tax liabilities, marginal tax brackets, how personal exemptions could be phased out. If you get too much income coming in 1 year, you actually start to lose your itemized deductions. And we'll also go more detail next week on capital gains dividends. For some taxpayers out there, if you have a lot of capital gain in one tax year, you're going to be subject to the alternative minimum tax. And so the capital gain and dividend tax rates won't even apply. There's also a new thing called the net investment income tax, the NII tax, which is often called the Obamacare tax. That's an additional 3.8% on top of the federal tax and state tax that you might be subject to. For retirees out there who are drawing their Social Security benefits, there's also a possibility of taxation of Social Security benefits. And then, of course, we'll get more into state taxes and tax case studies next week. For today, we're going to focus mostly on capital gain and dividend taxes. Capital gain would be for capital assets such as a stock, and the gain or the tax that you pay on it would depend on how long you own that asset. So if you hold a stock for less than 12 months and you sell it, it would be subject to ordinary income tax rates, which are typically going to be higher than your capital gain tax rates. If you hold a stock or a capital asset for more than 1 year, more than 12 months, your capital gain tax rates are going to be lower. So here in this chart, we're showing the maximum tax rate is going to be at 20%. So if you have a pencil, write this down. If you're in a 10 or a 15% marginal income tax bracket, your capital gain tax rate is actually at 0% on the federal level. If you're in a 25% tax bracket and above, your tax rate is going to be at a 15% capital gain tax rate. You don't get into the 20% capital gain tax rate until your marginal income tax bracket actually goes up to 39.6%. And so you don't have to worry about this really high tax rate unless your joint income or taxable income is over $457,000. And for single individuals, if your taxable income is over $406,000, then you're going to hit these maximum capital gain tax rates. The dividend tax is very similar to the capital gain tax rates. Basically, the same thing applies. If you're in a lower bracket, the qualified dividends have no federal tax. If you're in a 25% to 39% bracket, your capital or your dividends are taxed at a 15% tax rate. Now, the main thing to know about these capital gains and dividends is if you're in these lower brackets, as an example, I was recently working with a client where we calculated their taxable income was $34,000, and they could realize up to $74,000 of taxable income and still be in a lower bracket. So what we recommended is that they realize $40,000 of long-term capital gain, and they sold 600 shares of their company stock. It happened to be Medtronic stock, and they didn't have to pay any federal tax on it. They just had to pay their state tax. So if you're in these lower brackets, what you want to do is try to take advantage of this 0% tax rate on a year-by-year basis. Let's look at the employee stock purchase plan. I'm going to run through one example here of how the 15% discount applies on the value of your stock. So let's assume the investor purchased the stock at $40 a share during the offering period and then sold the stock at $60 per share. So in this example here, it's a qualified disposition. So let's say they held it longer than 1 year. What they'd have to do is, first of all, calculate and that they had a discount from their employer, and let's say it was at 15%, so that's $6 a share. Remember that $6 per share is taxed at ordinary income tax rates. Their cost basis is still going to be at $40 per share. That's when they purchased it. And so in this example, if they sold at 60, purchased at 40, they have a $20 per share long-term capital gain and a $6 per share ordinary income tax rate. So now where do you get this information on how to calculate your taxes? Well, you have to go through shareholder services or shareholder records. A lot of local companies, Medtronic, Pentair, 3M, they're using Wells Fargo as their transfer agent. So you could log into your Wells Fargo website, and the records typically will go back to 2001 because that's when they started keeping track of shareholders' records electronically. Now, prior to 2001, you'll need to dig up your investment statements and look at those statements and say, okay, well, we had a company stock split during this period, we had dividends that were paid out, we have to calculate in the discount, and we have to calculate all of our past sales that we might have had while we own this stock. Once you've figured out all that, which can take you a little bit of time, first thing is digging up all the records. Second thing is run these calculations. But after you've done with that, then you have to consider the different accounting methods. And so there's a few different accounting methods you could look at. The first one would be the first in, first out, which is referred to as FIFO. And the FIFO method is where you're selling the first shares that you originally purchased first. And then the later shares that you purchase, you're not touching those. And so the FIFO method, typically you're going to have a higher capital gain. The LIFO method, or the last in, first out, is where you're selling the shares that you purchased last first. Most companies will automatically default you to the FIFO method. So if you sell shares through the transfer agent like Wells Fargo, unless you tell them what shares you're selling, they're going to automatically sell those original shares that you purchased first. The other way you could do this is the average cost per share. And the average cost per share method is kind of what a lot of people are going to end up defaulting to because it's just the easiest way of going about it. It kind of rolls it all together. And if the tax inversion with Medtronic goes through, it probably makes the most sense just to use the average cost per share at this point in time. One other item I'd like to make you aware of: if your company becomes a company that's overseas or a foreign company, and Medtronic will be domiciled in Ireland after the inversion goes through, you'll need to, if you own an aggregate value exceeding $50,000 of a foreign financial asset, so if you own over $50,000 of stock in a foreign company, you will be required to file Form 8938 each tax year. So it's called Form 8938 each tax year. So just want to make you aware of that. Here I just have an example of a spreadsheet that we ran for an investor that looks at how to calculate the taxes, and we have the date that they purchased the shares, cost per share. We have the employer discount in here, and then if the stock sold at $40 per share, how much they would realize in value, and then what the gain is over in this column. So we have to know where you're at with the gain-loss column in order to calculate what your income taxes would be. So if you haven't done this exercise before, it can take up quite a bit of time and energy. If you have not done it, and if you're not really into running these numbers, then I would highly recommend just having a CPA or an accountant do these for you. We have a local accountant, Dan Freemuth, that could help you with these calculations. It would cost, he charges by the hour, and he's built out these spreadsheets to take into account all the splits and dividends and share price purchases with the employee stock discount. And he charges about $150 if you wanted to have a spreadsheet done on your stock cost basis. Let's go ahead and move into the 6 tax strategies that would help you reduce your tax burden. The first strategy is going to be deferring part of the gain. We'll also look at using pre-tax plans to reduce your tax liability. We'll look at gifting shares to family and to charity. We'll talk about liquidating any stocks that you have at a capital loss. And then finally, we're going to talk about changing your state of residency. This first example here, obviously I think it's going to be difficult for you to see on your screen, but what we're illustrating is that step 1 is to say, okay, here's where we're at in just a normal tax year without any capital gain. And so you can just say, okay, yeah, here's the bracket we're in. Here's what our here's where our deductions are. And just kind of putting some baseline numbers in. And I know a lot of people haven't done their 2014 returns yet. So in this example, we're just showing a 2013 return, which, basically 2013, 2014, 2015, there's not any huge differences in the tax laws. Example number 1, what we're illustrating here is an investor that last year said, okay, well, we have a lot of capital gain we're going to end up realizing. What would happen if we split the tax liability out over a 2-year period? And so you'll see that this taxpayer actually had $174,000 of long-term capital gain on these stock sales. And so we ran these tax calculations and actually found out if they split the tax liability out over a 2-year period, they ended up saving about $18,000 in federal and state taxes. And so I know it might be too late for shareholders at Medtronic to be able to do this at this time, but other shareholders out there that if you own stock in a company, be sure you look at the possibility of splitting the gains out over an extended period of time or over a couple of years. This example here is where we have the taxpayer just realizing all the gain in one tax year. And when you have a lot of gain in one tax year, obviously it's going to push you in higher tax brackets. You could trigger the net investment income tax. You could be over the limits and have to pay the 20% capital gain tax rate instead of the 0 or the 15% capital gain tax rate. So the good thing about running these tax hypotheticals is at least you're going to know where you're at. So you're going to be prepared, and you should really escrow money this year if you're going to owe tax for your 2015 tax year. I know you won't have to pay it in necessarily until 2016, but still I'd have that money ready to go and set it aside. The other thing that we recommend investors do is if they owe Minnesota state tax on capital gains, then they should consider making an estimated tax payment before December 31st of the next tax year, because then that way you can itemize the estimated tax payment on your federal tax return. So oftentimes it will help reduce your tax liability. And again, this could be $1,000 to $10,000 reduction in your taxes. So be sure to, if you're running your own tax returns, run hypotheticals for yourself, or else ask your tax professional to do this for you. Now, here's the next tax-saving tip for you. It would be to make the best use or maximize pre-tax contributions into employer-sponsored retirement plans. So if you're investing into a 401k, 403b, the first thing is it all stays tax deferred for you until you start taking the money out. It could lower your current tax liability, so it might get you in a lower bracket. And then this other bullet point here says annual contribution limits. Just so you do know, in 2015, the contribution limits, if you're age 50 or younger, or excuse me, prior to age 50, the contribution limit is $18,000 pre-tax. For those people age 50 and over, you can add in an additional $5,500 called a catch-up provision. So you could add a total of $23,500 into a pre-tax 403B or 401k. And again, the advantage of these plans is you get an employer match typically up to a certain percentage, maybe 50 cents on the dollar up to 6%. It's all tax deferred. And we think this is probably the very first step for investors out there that are going to have to realize capital gain or realize stock sales this year, is to go ahead and max out what you can into your pre-tax 401k contributions. Now, we've had clients do this, and oftentimes they'll say, well, geez, now I don't have much of a paycheck to live on anymore. But remember, what you could do is just use some of those stock sale proceeds for your income needs this year. And then also you could use stock sale proceeds to put into other investments. Now, the other investment ideas or tax deductions could be individual retirement accounts. There's a traditional IRA. A traditional IRA, if you're under age 50, you can contribute $5,500. If you're over age 50, you can put in another $1,000, so you can put in $6,500 pre-tax into traditional IRA. This traditional IRA, if you have an employer-sponsored 401k plan, 403b plan, you're probably not eligible. But if you have a spouse that isn't eligible for an employer-sponsored plan, you can still do these traditional IRAs. Or maybe you're working part-time, the traditional IRA might be a good tax option for you. The Roth IRA is another great idea. If you have stock sale proceeds, you can put up to $5,500 or $6,500 into the Roth IRA. And the beauty of the Roth IRA is you can purchase an investment like a mutual fund or another stock, and it accumulates tax-free, and as long as you leave it there for at least 5 years. It's all tax-free growth. It's tax-free to your heirs. You can use it for higher education needs. There's a lot of different purposes for a Roth IRA. So we'll talk more in detail about the traditional IRA and the Roth IRA next week in our tax class. But if you haven't looked into these, it's a nice tax option for you. Now here's another idea that involves if you have shares of stock and they've appreciated, and you're saying, okay, if I sell them or realize the gain in my tax bracket, it's going to be a lot higher than my child's tax bracket or a grandchild for that fact. And so if you just look at this area here where it says unearned income, this slide here is a little bit dated. It's actually under age 19 if the child is not still working on their education, but it's if the child is under age 24 and a full-time student and not supporting themselves, they're still considered a child for their tax return purposes. So this slide here should say under 19 and then under age 24 if you're a full-time student. But basically how it works is the first $1,000 of gain the child has, there's no tax. It's exempt. The next $1,000 to $2,000, it says 10%, but actually if it's a capital gain, it's 0%. And then anything over $2,000 of gain goes back to the parent's tax bracket. And so that, obviously is going to be higher than the child's. But the advantage to doing this, and we've had quite a few clients last year that took advantage of this tax law on accumulated shares of company stock that they had a low basis in. So let's say the stock is trading at $70 per share, and you originally purchased the shares at $30. So that would mean you'd have a $40 capital gain on those shares. So now if you gifted 50 shares of stock to one of your children or grandchildren and they sold it and realized the gain in their tax bracket, basically there'd be no tax on it. It's a 0% federal capital gain tax rate. They'd have some state tax, which is obviously going to be lower than your tax rate, but you potentially could save, in this example, on these 50 gifted shares, it saves about $400 of taxes, or even closer to $500 when you include the state of Minnesota tax. So this tax strategy works quite well, and as I mentioned, we've had several of our clients that gifted to their children, and we had one client that actually gifted to 5 of his grandchildren, and literally saved about $2,500 of taxes doing so. Let's move on here. We'll talk a little bit about charitable contributions. Now, for people that have highly appreciated assets, if you're gifting the stock directly to charity, it will end up enhancing the value of your gift. I'll show you why that is in a tax example. It may qualify for a higher tax deduction, and it can help you reduce or avoid capital gain taxes. So basically, when you're gifting, let me go back a slide, when you're gifting shares directly to a charity, the charity would receive the shares of stock, and the charity can sell the shares of the stock, but they don't have to pay a capital gain on it because they're a nonprofit, a 50C13 corporation. So they have no gains. Nobody has to pay tax on it. Now, as the donor, what you get to do is you get to write off, or if you're itemizing on your tax return, you get to write that off as a deductible contribution to a charity. So in this example, we've completely avoided the capital gain on that sale of stock, and then plus you've gotten a deduction to do so. Now, in addition to that, what I'd like to mention is some corporations like Medtronic have a program called the Global Mission in Motion Matching Grants Program. So basically, they will match your donations to nonprofit institutions from a $25 gift all the way up to $100,000 of matching. The advantage for employees is that you double the amount that you're gifting to a nonprofit. So let me give you an example of what we've done for clients in this area. So we had one of our clients said, okay, hey, I'm giving to charity on a regular basis, on an ongoing basis, and I plan to do so in the years to come. And so what we looked at and recommended is this client actually gifted $10,000 of stock shares to what we call a donor-advised fund. And a donor-advised fund is basically you're gifting those shares. The charity or the nonprofit organization is going to sell those shares, and then what they do is they take, in this example here, they took the $10,000 and they put it into, it happens to be a mutual fund. It's basically a mutual fund that can be invested for whatever risk the client chooses. So the $10,000 is still there in the mutual fund. The client got the $10,000 deduction, now has a mutual fund in the donor advised program, and each year they get to direct how the earnings growth off that mutual fund goes to the nonprofit organizations. Now, the beauty of this, in addition to that, Medtronic matched that full $10,000 into their donor advised fund. So the client, the net to them is they got a $10,000 tax deduction for the gifted shares, plus they got a $10,000 match from Medtronic, so now they have $20,000 in their donor advised fund, and then what they get to do each year is they get to decide how much goes out to their different charitable causes. So they could give money to Salvation Army or the Boy Scouts of America, or whoever they want to on an annual basis. And if they want to gift it out annually, or maybe they want to gift it out all at once, they could just gift the full $20,000 after they get that match. But main idea here is if you're charitably inclined and if you have highly appreciated stock, to take a look at these matching grants program and the donor advised funds. And I will mention too that the tax inversion with Medtronic has not gone through yet. It's voted on to go through, But all these things that, gifting to children, along with using donor advised funds, these are still strategies that you could implement before the final date of the inversion. So I'd suggest getting right on it. Don't wait even a day to start on these things. We do have an example here in this slide where we have shareholder Winnie and Chris that are donating their stock. Winnie decides to sell her stock, then donate the money. So she ends up donating $4,400, where Chris, he donates his stock. He ends up donating $5,000. So when you crunch the numbers on the value of the charitable deduction, Chris ends up actually gifting about $750 more than Winnie does if she sells and then donates later. So you can see the power of this example here. There's another area that you could use. It's called a charitable remainder trust. We don't see as many people doing these because they're, unless you have a gain of $1 million or more, these things aren't very, they're fairly expensive to administer. But if you do have interest in this, we could certainly run some numbers to see if that's a good solution for your plan. One other idea that we've seen clients implement is changing states of residency. And so Minnesota happens to be, I think, the third highest tax state out of 50 states. And so if you have a lot of income coming in at retirement, and if you have the flexibility, you could move to a different state like Florida or Nevada, Oregon. Those are Texas. Those are some states that do not have state income taxes, so you just pay your federal tax. And we've had, probably about 6 clients last year that actually changed states of residency, and they've saved from $10,000 to $200,000 of taxes by doing so. So it might be a little bit late in the game for some people to do this, but it's always a consideration to look at when you're retired and have that flexibility in your plan. If you want to do so, there's some determining factors that you have to follow. They're very rigid because the states are very, don't like losing their taxpayers. So we have a list that we could email out to you that you better adhere to. Otherwise, you could end up getting into a tax audit situation and having to pay back that state income tax. Now let's wrap it up. To sum things up, I'd recommend a couple things. Grab your pencil, write this down. So here we go. 7 different things. Number 1, sign up for your employee stock purchase plan if you're still working at a company. And also encourage others to sign up for their employee stock purchase plan. You get a great discount on the stock, plus you don't have to pay the FICA tax. So you have a 20 to 30% return on your money before it even grows. Number 2, calculate your cost basis in the shares of stock that you own. So start working on that. Start getting the documents together. Have an accountant help you with it. Number 3, do tax estimates to find out what your capital gain tax rate will be. So kind of know where you're at in these tax brackets, and then go through the equation of figuring out how can you get in a lower tax rate. Number 4, maximize your pre-tax investments. Put what you can into the 401k, 403b, IRAs. Bring your tax liability down. Number 5, consider gifting shares to your family, to kids, to grandkids. And you want to be right on top of that right away, early in the year. And number 6, consider gifting shares to charity. Number 7, you can change your state of residency and be sure to pick someplace warm in the winter so I can come visit you. And of course, lastly, if you have any questions, feel free to contact Summit Investment Advisors. If you need help with any of the above, we could schedule a phone call or a meeting, and we do complimentary consultations. So with that said, thank you for your time today, and I will be answering some of the questions that were chatted in. Once again, if you're on this conference call, if you attended a little bit late, please click on that orange icon on the top of your screen where it has that person there. Click on that as a participant, And then if you could click on the first person and then type in your name so that we know that you attended the workshop and we have some special material that we could send out, like the slides or anything else. So with that said, I'm going to just take a moment here and then we'll see if there's any questions that came up.